Hi, Stephen Garcia here, and I am urgently contacting you today to tell you that we are at the dawn of America's last great real estate wealth building window. The next few years could go down in history as one of the best times ever to acquire investment real estate, if you understand why. You see, we have had a straight ride up in real estate valuations over the past 40 years, and if you have recently been seeing flashbacks of what you saw in 2008, I have some news for you. Your suspicions are correct. We are smack in the middle of the greatest real estate bubble in history, and when it bursts, it will devastate millions of investors and homeowners. The blue line in this graph represents the U.S. Home Price Index from 1986 to 2019, and the gray shaded vertical lines represent periods of U.S. recessions. To make things simple, let's use the values located on the left to communicate the price paid for one house. If you bought a house in 1986, you would have paid about $60. If you bought that same house 10 years later in 1996, you would have paid about $80, which would be about a 33% increase. And over the next 10 years, if you bought during the great peak of 2006, you would have paid about $180, or a whopping 125% more. That same house today is $212, or 18% more following the 2006 peak, and 50% more than its 2012 bottom. Many mainstream analysts say that this real estate bull market is here to stay, and that prices will continue to go up over time. I understand this might come as a surprise to you, as I am here to tell you that this house may never be worth more than what it's valued today, not in our lifetime. In fact, over the next 40 years, home prices will be very different. Appreciation will be much slower and subdued. Let's follow the money. In the 2000s, money flowed to residential real estate, creating an epic bubble. This decade, commercial real estate is capital rich. Look at U.S. commercial prices, which includes multifamily, retail, industrial, and office, as they are also at peak pricing, and much like residential pricing, have risen drastically since the mid-1990s. So much money has flowed to commercial real estate this decade that prices are 35% more than the 2007 peak, but more impressively, commercial property has more than doubled in value since bottoming out in 2009. Here's a breakdown of different commercial types. Apartments have been the undisputed darling of the entire real estate industry, as its price index has risen faster than any other major commercial property type, 80% above its prior peak. Much like residential, commercial prices will also be slower to appreciate over the next 40 years, but will be in a much better position than residential because commercial property is valued on the ability to produce income, while residential property is valued on local sales comparisons. The ability to increase the net operating income is the ultimate lever that gives commercial property a huge advantage over residential investments. For this reason, commercial income producing investments will provide much more stability for income and growth after this next financial reset. If you have been sitting on the sidelines or you've been chased out of real estate deals because you have been outbid by investors or home buyers willing to pay top dollar for the same income stream or home, then you're not alone. Some of the smartest people I know have been spending crazy amounts of money for both residential and commercial real estate. There is too much money and not enough deals. And when you have an oversupply of money and an undersupply of investments, prices go up and returns go down. But please pay close attention to what I'm about to say. This is your last warning, your final chance. You'll never see another opportunity like this again, not in our lifetime. My research indicates the real estate bull market is nearing its end, and a new panic is approaching, unlike anything you might expect. Now, you may disagree with my prediction or believe this sort of outcome is impossible. And given the recent performance of the real estate market, it'd be very hard to blame you. However, as you will eventually see, it's happened all before, and not just once. It's happened several times. Now, for reasons I'll share in just a minute, I believe it's about to happen again, with conditions paving the way to America's last great real estate wealth building window. Those who remain cool, collected, and unemotional will fare best. Not even would I have said this at the peak of the 2006 real estate cycle. Even then, I was buying in growth markets with great supply and demand fundamentals. But today, we are at a crossroads in America, where over the next 40 years, one macro factor will subdue the real estate appreciation we have become accustomed to. In today's market, time and patience will do more for your money than strength or passion. Before I explain why I believe what I do, let me introduce myself. Hi, my name is Stephen Michael Garcia, and I have been a real estate investor since 2006. I am currently the lead acquisitions manager at Michelson's Investor Group, where I have acquired several single-family rentals to multifamily apartments worth millions of dollars. I bought my first single-family rental in Dallas, Texas, at the peak of 2006. I did well with that first investment, even in the midst of one of the biggest financial crises in U.S. history. So here's the thing. I had friends and acquaintances who bought in other markets around the same time and lost their investments. But I don't have to tell you that, since everyone knows someone who was affected by the 2008 recession. I'm fortunate enough to have never lost any money in real estate. And that's the question that's bothered me. Why did some investors do well while others lost everything? I began to study this question so that I could be the best real estate investor I could be. What you're about to listen to is the result of a decade of passionate, independent research to produce something impossible to find in one-sided real estate seminars or meetups. This is research free of hidden agendas and conflicts of interest. The results of my research surprised me, and that's why I'm reaching out to you today. I have uncovered something that not very many people are thinking about and will have huge short and long-term effects for present and future real estate investors. You see, over the past decade, the market got off one financial tsunami and is now riding an even bigger one that will soon crash in 2020 or 2021. If you make the right decisions today, you could learn how to preserve your wealth and cash in on America's last great real estate wealth building window. Stay tuned until the end of this presentation as I explain why U.S. home prices may never again in our lifetime be what they are today. While no one is going to ring the alarm bell for us to let us know that it's time to protect our wealth, I can tell you there are always signs. The trouble with those signs is that while they're obvious with the benefit of hindsight, they aren't so easy to see in real time. The best example comes from the months leading up to the Great Depression of the 1930s. JFK's father, Joseph Kennedy Sr., noticed one of those subtle signs and got out at the top of the stock market just before it began to crash in October of 1929. For virtually anyone invested in the stock market, the Roaring '20s were good to Joe Kennedy Sr. How could they not be? All you had to do was buy all the stock that you could and watch it go up. After having made a bundle owning stocks in the roaring bull market of the 1920s, Joe Kennedy Sr. found himself needing to get his shoes polished. While sitting in the shoeshine chair, Kennedy Sr. was alarmed to have the shoeshine boy gift him with several tips on which stocks he should own. Yes, a shoeshine boy was playing the stock market. This advice resulted in a life-changing moment for Kennedy Sr., who quickly went back to his office and started unloading his stock portfolio. No one was ringing the alarm bell, but apparently, when shoeshine boys start giving stock advice, it's time to head for the exits. Shockingly, I have a similar story from this year. I was traveling and picked up from the airport by a rideshare service. We had a good drive to get to my hotel, and I always like to chat to the locals to get advice, where to visit and eat. I told the driver that I was in town to shop real estate. As I was dropped off, the driver pulls out a business card and tells me that some friends are buying an apartment complex and are looking for partners, so I should call if I were interested in investing. Today, when rideshare drivers attempt to raise money for real estate deals from out-of-town visitors, is that a sign of market euphoria similar to Joe Kennedy's 1929 shoeshine boy experience? I'm not going to answer that. That's a rhetorical question for you to think about as I share this ridiculous photo trying to dramatize my rideshare story. Anyways, to make matters worse, and one of the biggest reasons I have decided to create this informational video for family, friends, and fellow real estate lovers is because I see a lot of half-baked advice being dished out on webinars, seminars, and meetups. I have heard real estate gurus, builders, and analysts focus on the great fundamentals of real estate, which is typically hyper-local, including elements of only supply and demand. And that's great, because all real estate is local. There is no national real estate market, since different cities and even submarkets within those cities have supply and demand characteristics that will give them a unique investment profile of income or growth. But understanding these local supply and demand fundamentals is no longer enough, because the third factor has become so important that it now creates the biggest threat and equally the biggest opportunity to an investment's ability to produce cash flow or appreciation. And you know what? It's the X factor that no one is talking about, since it's not a local phenomenon. It's a national phenomenon, and it's the oxygen that enables housing supply and demand fundamentals to breathe at the local level. Just as real estate prices are affected by the direct relationship between the supply and demand for housing, so is the cost of money affected by its own supply and demand fundamentals. If the money supply loosens with low interest rates, it creates more demand for loans, pushing real estate prices up. If the money supply tightens with higher interest rates, there are fewer loans, pushing real estate prices down. And if there's a financial crisis like 2008, much like extinguishing a fire by sucking out the oxygen that feeds it, the money supply can crush any fire-hot local economy if the ability to access money is sucked out of the financial system. You see, when this happens, it doesn't matter whether local real estate supply and demand fundamentals are strong. For the sake of understanding how America's last great real estate wealth building window will materialize, it's critical to understand the components of the money supply. Why do you need to understand this as a real estate investor? Well, because, like I mentioned, interest rates and loan availability are so important to real estate returns and pricing. Interest rates are just tools used to fight inflation and deflation. Inflation is when prices rise and is considered to be healthy, as long as it's steady and controllable. Deflation is when prices drop, and a sign of an unhealthy economy. Interest rates can be short or long-term tools, and they have a huge impact on how much money is pumped into our economy. The Fed manipulates the short-term rate that influences bank-to-bank lending, consumer savings, and spending. So how does this short-term tool influence private banks? Well, the bigger the spread between the Fed's short-term rate that banks pay to borrow money and the longer-term rate they charge for lending that money creates more profit, an incentive for them to increase the money supply. And how does this short-term tool influence people who save money? Well, when short-term rates are low, it penalizes savers, especially if inflation is higher than the bank's savings rate. There is little incentive to save money today when banks pay 0.1% and inflation is 2%. When savers are losing $1.90 for every $100 kept in the bank, it incentivizes people and businesses to use the money supply to borrow and invest savings for higher returns. And how does this short-term tool influence consumer spending? Well, low short-term interest rates allow those with insufficient savings to buy something inexpensively. When I can go to Best Buy and finance a $2,000 television at 0% over 24 months, money is practically free. When financing consumables is so cheap, people utilize the money supply to spend more. And what about those long-term interest rates? Well, it's the market forces, which usually is comprised of governments, businesses, and individuals, who control long-term interest rates through their investments in the U.S. government bond market. The bond market is just government debt that investors can buy for a return. The 10-year Treasury is the most popular U.S. bond in the world, most likely because it's secured by the guarantee of the U.S. economy. Demand and supply for the 10-year Treasury influences the interest rates consumers and investors pay to buy long-term credit, like fixed mortgages and car payments. The lower the return on the 10-year Treasury, the lower our fixed-rate mortgages and car payments will be. The reason you can get a 3.5% fixed 30-year home mortgage is because the day you locked in your rate, the 10-year Treasury was most likely trading at 1.5%. In order to compete for investors, lenders who are selling riskier long-term credit like mortgages or auto loans need to offer a 1 to 2% premium over the risk-free rate of return of the 10-year Treasury. That means a lower 10-year Treasury encourages long-term borrowing and an expanding money supply. Now that we know what the difference is between the short and long-term interest rates and who controls them, let's chat about how changes to the money supply can influence consumer inflation and interest rates. Today, money has never been so cheap and plentiful. What I mean by cheap is when you borrow money today, the interest you pay is very low. And when I say plentiful, there are many people out there that want to lend you that cheap money. This graph shows consumer inflation in blue bars and short-term interest rates as the yellow line. When there is a consumer inflation or prices rise, interest rates rise, making it more attractive to save money. This scenario is represented on the left side of this graph before the peak of 1981, when the U.S. had high consumer demand and a limited money supply. When deflation happens or prices drop, so do interest rates, which incentivizes people to borrow. This scenario is on the right side of this graph, after the 1981 peak, when the U.S. had equally high consumer demand, but an expanding money supply. It's easy to see the trend. The more the money supply expands, the lower interest rates fall, following lower inflation. It's believed that a growing money supply causes inflation, but this graph proves otherwise. Fast forward to today, and the money supply is on steroids. Even with the Fed printing an unprecedented $4.5 trillion to inject in our banking system, tax cuts putting more money in people's pockets, and record low unemployment, we still have almost no consumer inflation. How is that possible? Well, it's because the money supply has increased much faster than consumer demand. For example, my house has 3 bedrooms and a 2-car garage. So even with zero interest on money that I can borrow, I'm only going to need 2 cars and 3 TVs at most. Even with interest rates at their lowest in human history, there is only so many cars, clothes, and $6 lattes people can consume. Before the 2008 financial crisis, interest rates always chased inflation, keeping inflation in check, which is analogous to a dog being in control of wagging its own tail. In past economic expansions, interest rates would rise in response to inflation, especially in the late stages of an economic boom. But in today's record-setting economic expansion of over 10 years, the relationship has reversed. Now, we have record low interest rates being used to prop up inflation. Now, the tail is wagging the dog. Strangely enough, thanks to these low interest rates, we have kept deflation in check. Using the money supply to keep deflation in check is irregular and a sign that our economy is much weaker than most people think. So, now we know if consumer inflation is low, then short-term interest rates are low. But the money supply has also kept long-term interest rates equally low, which has been feeding another kind of inflation. By this point, you should be asking yourself this specific question. How is it the U.S. has record inflated prices in stock, real estate, and bond markets, while consumer inflation is at record lows? Well, it's because investments aren't included in calculating consumer inflation. Consumer inflation is calculated by the money people use to buy goods and services, not the money they use to invest. So there are 2 different kinds of inflation, consumer and investment. U.S. consumer inflation peaked in 1981 when short-term interest rates reached 19%. Just like the ingredients that fuel real estate pricing, consumer inflation is the result between consumer demand and how much access they have to suppliers of goods and services and how much access they have to the money supply. Let's talk about consumer demand. After World War II, the U.S. experienced a baby boom on a scale that had never been seen. This population increase was like a 10-foot wave compared to the previous generation, which was more like a 4-foot wave. This baby boom generation has ripped through the U.S. economy in tsunami-sized waves, triggering massive consumer inflation in any economic sector that has tried to serve them. Look at the demographic pyramid on the upper right corner, showing the 1981 U.S. population by age distribution. Older people are on the top, younger people on the bottom, men on one side and women on the other. In 1981, the first wave of baby boomers turned 35. The biggest reason consumer inflation steadily increased after World War II to its peak in 1981 is because the sheer size of the baby boom generation. Think about it. People under 40 years old tend to spend, not save or invest. It's all about the kids, diapers, food, cars, restaurants, rent, college tuition, and today even pot. It's spend, spend, spend. The baby boomers were the biggest reason consumer inflation was sky high in the 1970s and 80s, for the simple reason that young people are consumer inflationary. Let's touch on consumer supply. Globalization entails the flow of people, goods, and capital. As young people are consumer inflationary, globalization is equally consumer deflationary. The U.S. has benefited from globalization by accessing other countries' people, goods, and money. 2 billion people across the world today still live on less than $3 a day. Globalization allows the U.S. to tap into that almost limitless supply of low-cost labor to make stuff for us on the cheap. This is a big reason consumer inflation has been low in the U.S., even with the huge millennial generation. Today, we have never had so many options of car dealerships, toys, clothes, Christmas decorations, etc. And that's the idea of globalization. More options means more competition, and the benefit is better quality at lower prices. It was the lack of global supply chains and limited money supply that made things so damn expensive for our parents and grandparents from the 1960s to the early 80s. It wasn't until the mid-80s where globalization and the increase in the money supply really started to pick up, which ultimately created the right conditions for the next kind of inflation. U.S. investment inflation is peaking now, with the 10-year Treasury bond rate below 2%. Let's chat about investment demand. The same reason we had such high consumer inflation in the 1970s and 80s is the same reason we have such high investment inflation today. The baby boomers grew up. Now instead of spending, they're investing. In 2019, the first wave of baby boomers turned 74. Most are empty nesters, not having to worry about kids, diapers, college tuition, or other expenses that involve consumption. At this life stage, they're concerned about retirement and putting that extra disposable income to work through investing. The sheer volume of this generation has hit stocks, bonds, and real estate with such a magnitude that investments have skyrocketed since the mid-1990s. Now let's talk about investment supply. Today, globalization is on full throttle, and that even applies to investments. We have a lot of money circulating in the developed world like Europe, Canada, and the UK, and they too have older demographics like the baby boomers looking to invest, and a lot of that money comes to U.S. real estate, stocks, and bonds. This free flow of money across borders has provided extra lubrication to push interest rates down and investment inflation up. But how does the money supply fit into all of this? Well, the money supply has also skyrocketed since one significant event occurred, which has given governments much more influence over the crazy volatility we have seen in our economy and will heavily contribute to America's last great real estate wealth building window. What happened over 40 years ago that would pave the way to the unprecedented wave of capital ripping through our economy today? Well, up until 1971, the U.S. central bank could only create as much money as it had in gold reserves. After decoupling the U.S. dollar from gold, the Fed had the ability to create an infinite amount of money, and they have done a damn good job ever since. Once money ceased to be backed by gold, credit creation, rather than savings, began to finance the borrowing of the U.S. government, households, corporations, and financial sector. No longer constrained by the gold standard and a limited pool of savings, credit growth exploded, creating a wave of capital that continues to grow the money supply even today. If we had remained in this classic capitalist system, we would have about $38 trillion of savings to finance economic growth. But the new economic system, backed by credit, has given us the ability to double our money supply. Today, total U.S. money supply is over $77 trillion. This $77+ trillion credit load is over 3 times as big as the entire U.S. economy and is now the economic growth engine to our financial system. If credit stops growing, our economy stops growing. Period. This increase in the money supply is one of the biggest reasons for investment inflation of real estate, stocks, and bonds, and has created a wealth effect in the U.S. that would not have otherwise been possible. The challenge with the credit economy is that it requires continued credit growth to survive. If credit slows or contracts, it would immediately bring on the very economic crisis that this theory of an increasing money supply so strongly tries to protect against. You see, we are being held hostage by our own nasty spending addiction. It's much like a crack addict that needs more crack to feel good, and if stops cold turkey, risks severe withdrawal. 2008 was a recession. This next economic event could be a depression because the answer to the 2008 debt addiction was more debt. The markets were not allowed to self-correct. We have gone from $58 trillion of debt in 2008 to nearly $77 trillion in debt today. The 2008 financial crisis was triggered from consumer debt, shown at the bottom of this chart in dark blue and red, where a majority of the money supply increase from 2000 to 2007 went to residential real estate mortgages. To put things into perspective, the weakest link of the 2008 debt chain was subprime mortgages bought by borrowers with low income and poor credit. This small group of subprime borrowers represented 10% of total U.S. consumer debt, or $1.5 trillion, which equated to only 2.4% of the total $58 trillion U.S. debt load. Although a small amount of risky debt from U.S. Main Street, it was big enough to cause a chain reaction of events that crushed Wall Street, eventually turning into a global financial crisis. This $1.5 trillion U.S. subprime debt ripped through the world's $600 trillion derivatives market, losing investors trillions of dollars and bankrupting financial institutions like Lehman Brothers. You see, the 2008 housing bust was not caused by local real estate fundamentals. It was really caused by national money supply fundamentals. The real estate was good. It was the money that was bad. Today, we are levered up 31% more than in 2009. So what could be the weakest link in the debt chain that triggers a greater financial crisis today? Well, we learned our lessons from 2008, so home mortgages and financial sector debt are down. But there is a lot more debt flowing to consumers, which is up 53%. For example, the same banks that were selling mortgages to subprime borrowers are now selling loans to students. Student loans are 11% of total consumer debt, for a record high $1.5 trillion, which has increased approximately 140% since 2009. Or what about today's new bad consumer loan trend of subprime auto loans, which represent 20% of all auto loans and 2% of total consumer debt, for a total of almost $300 billion? Or will it be corporate debt that has grown 44% since 2009 to over $15 trillion, of which $1.1 trillion is considered to be junk debt, and another $2 trillion is close to junk? Today's global interconnectedness can be felt even more strongly in the $500 trillion financial derivatives market. Sure, it's less than 2008, but still a scary high figure. These packaged and repackaged securitized financial instruments could topple like a house of cards if the underlying assets that created the derivatives defaults on its credit payments, just as it did to those subprime mortgage borrowers in 2008. You see, much of the same conditions exist today that caused the 2008 global meltdown, which was triggered by only $1.5 trillion of risky debt. In 2019, we're looking at more than $5 trillion of private sector debt that can be categorized as risky. Even the less risky public debt has grown. U.S. government debt has blown up by 77% to $27 trillion. And this is only in the U.S. There could be something in the global economy that we don't even know about that could create a global financial domino effect. Just like every season of Game of Thrones hinted that winter is coming, every recession that has occurred since the U.S. dollar was decoupled from gold has brought the U.S. economy one step closer to another tipping point. Today, the reason a strategy of strength and passion for real estate acquisition is at a huge disadvantage is because an event that has happened about every 100 years for the last 3 centuries, making it more rare than a total solar eclipse or even the appearance of Halley's Comet. America's last tipping point was in 1929. Before that, it was 1836. Since it's so rare, as people we tend to forget about these great financial resets or tell ourselves that it won't happen again or now things are different. But if we study history and people, we can easily see that human nature and history tend to repeat. These great financial resets happen on the tail end of a perfect storm of falling economic, political, demographic, and technology shifts. They're natural and detoxify our economy from financial excesses. We just need to be aware that these resets exist and prepare for when they're most likely to occur. Many tell me that this next downturn will not be as bad as 2008. It gives me no pleasure to tell you that it could be as bad, if not even worse. Why? Well, for the simple reason that the U.S. government did not allow the markets to self-correct in 2009. The Fed immediately started to reflate our financial systems by, you guessed it, more debt. The same levers used by the government in 2009 to reflate U.S. financial systems will be less effective this time around, much like a drug addict needing a bigger fix to feel any effect. Overdosing financial stimulus will contribute to the end of the last great bubble of our time, greatly impacting the U.S. wealth effect over the next 40 years. Stay tuned as I explain how this last great bubble burst will affect real estate prices for the rest of our lives. But first, I'd like to define America's 1836 tipping point. This great financial reset bottomed out in 1842. Every financial reset has a trigger, like the 2008 financial crisis rooted in residential subprime mortgages. The 1836 trigger was rooted in the biggest real estate bubble the U.S. had ever seen. The crisis was caused by the Great Migration from the East Coast to the Midwest, specifically Chicago. The migration was financed by government incentive giving away very cheap land and regional banks financing this huge surge in real estate purchases with cheap money. At this time, there was no federal bank, so these bank lending practices were unregulated by the government, causing the money supply to surge. Instead of limiting their loans to the amount of actual gold and silver they had in their reserves, these regional banks started to give out money in the form of paper notes. In other words, they started printing money. Does that sound familiar? Subsequently, from an increased money supply, loans became very cheap. This cheap money bid up real estate, resulting in sky-high asset prices and the subsequent reset of the 1840s that took stocks down too. America's second tipping point started in 1929 and bottomed out in 1933. By the 1920s, America had the Federal Reserve controlling the interest rates of the country's money supply. However, in its infancy, the Fed made a similar mistake. The Fed held interest rates too low, flooding the economy with cheap credit. This cheap money fueled the Roaring '20s. It was primarily a stock market bubble since everyone from Joe Kennedy to a shoeshine boy were putting 10 to 20% down to finance large purchases of stocks. And this only works if valuations keep on going up. This created the biggest stock market reset in U.S. history, and real estate went down with it. However, the stock market was so inflated that it took 26 years for it to get back to the 1929 highs. When these financial instruments bubble up so dramatically, it takes quite some time for them to recover from previous peaks. You can probably see where I'm going with this. If a high money supply and low interest rates created conditions for each past tipping point, the foundation for today's tipping point is totally unprecedented. Never in the history of the world has there been so much money created. The U.S. alone has created $4.5 trillion out of thin air since 2009. Never in the history of the world have interest rates been so low for so long. Some countries even have negative interest rates. Coincidentally, never in history has U.S. household net worth been so high. And never have we seen all three investment classes so inflated. Stocks, real estate, and bonds are at record valuation levels all at the same time. This is the unprecedented everything bubble. This cannot end well. We have seen it time and time again. The greater the bubble, the greater the burst, and the resets usually go back to their starting point or even go a bit lower. When the sun sets on this historic 100 years tipping point, it could take us back to valuations of the late 1990s, if not even lower. Getting back to normal averages of U.S. household net worth will most likely happen, along with the end of investment boom-bust cycles. So this is the moment we've all been waiting for. What exactly is America's last great real estate wealth building window? Well, to figuratively sum it up in one word that doesn't exist in English, I would use the Japanese word kiki, which means crisis. But the Japanese definition combines the meaning of danger and opportunity in the same word. This is a great word to describe America's last great real estate wealth building window that will last from 2021 to 2024. But in this danger, the U.S. will find opportunity, championing great political, social, and economic reforms that will make this great country even stronger. But what does America's last great real estate wealth building window literally mean for real estate investors? Just means ultra-low prices and ultra-low interest rates. Money will get scared and run for the exits, causing prices to consistently drop, bottoming out through 2024. And remember what the governments do to fight deflation? Well, to try to prevent an economic collapse, the government will artificially drive interest rates down. It's just that simple. America's last great real estate wealth building window will be the last period of our lifetime to maximize both cash flow and appreciation through a combination of low prices and low interest rates. After the next tipping point, interest rates will slowly and gradually increase, and bankers will be heavily regulated, making it more difficult to get loans. The political and social reforms that follow will attempt to transfer wealth from Wall Street to Main Street USA. However, it will be the change in the relationship between the demand and supply for U.S. dollars and bonds that will weaken real estate appreciation. Look at this chart comparing the 10-year Treasury in red versus the U.S. Home Price Index in blue. There is a direct correlation with interest rates and home pricing. The lower the 10-year Treasury goes, the higher home prices appreciate. The U.S. 10-year bond is long-term debt issued by the government and the foundation for mortgage interest rates. This bond market has been bubbling for 40 years during both economic booms and busts, but especially during economic busts. When investors get scared, they drive the 10-year bond price higher and its return lower. For this reason, the 10-year bond will continue to bubble during America's last great real estate wealth building window, keeping interest and mortgage rates ultra low. But then, it will be the final bubble to burst, sending 10-year bond rates higher, changing the real estate investment game for the rest of our lives. This is specifically for my commercial real estate friends. The average apartment real estate cap rate is the blue line, and the 10-year Treasury is the orange line. You can see that the capitalization rate ebbs and flows with the 10-year bond rate. And just like the 10-year bond, as apartment cap rates go down, the value of the property goes up. Since 1990, the average spread between these two rates is about 3%. Today's apartment cap rates are at record lows and valuations are at record highs. This is possible because the 10-year bond rate is so low, subsequently making mortgage interest rates low. So what happens to cap rates and valuations when the 10-year Treasury starts to tick back up? Same results as residential real estate. Appreciation will never be the same. However, commercial real estate is valued by its ability to increase net operating income, and it has so many more levers to pull that can create additional income streams that single-family investments just don't have. Therefore, commercial real estate will have an enhanced ability to create capital appreciation over time versus residential real estate investments. The bond market today is the biggest bubble there is, and it's been bubbling for 40 years since 1981. In the U.S. alone, bond markets make up almost $40 trillion in value, compared to less than $30 trillion for the domestic stock market. The best way to predict the future is to study the past. Look at the 10-year Treasury since the 1800s. It appears that every 60 years there's a top in interest rates. From 1860 to 1900, the bond market roared with low interest rates and high valuations, and then it flipped for 20 years until 1920, losing value and rising interest rates for a full 60-year cycle from 1860 to 1920. Then, from 1920 to 1950, interest rates start to drop again as the bond market roars for 30 years before turning and then tanking for 30 years, topping out in 1981 with record high interest rates and low bond values to complete another 60-year cycle. Today, we have 40 years of the greatest bond market rally in history, with rates below 2% and bond valuations sky high. In the early 2040s, we should see another long-term interest rate peak to complete the 60-year cycle. The bond market will be the last bubble to burst. As the 10-year Treasury rate rises, mortgage interest rates will rise, and real estate appreciation may never be the same in our lifetime. Although it's important to study history to predict the future, it's equally important to understand what present conditions will allow history to repeat. Interest rates will rise after the bond market bust from a huge imbalance in the U.S. money supply. You see, in good economic times, countries tend to take in more money than they spend, called budget surpluses. The inverse happens in bad economic times, as the government steps in to give financial CPR to the economy by spending more than it takes in, resulting in deficits. In 2008, the federal deficit was about $460 billion. When the great financial crisis started, the U.S. government immediately turned on the money printing presses, and by the end of 2009, the federal deficit increased 3 times over to $1.4 trillion. Fast forward to 2019. The U.S. is spending $1 trillion more than it collects, and it's considered to be good economic times. During this next tipping point, expect the Fed's printing presses to be working overtime, as it will most likely spend $3 to $4 trillion more than it takes in every year to keep the economy on life support. The Fed will flood the financial markets with overdosing amounts of bonds to finance these huge deficits. At the same time, the U.S. has a very important group of aging people that can no longer withstand another round of investment volatility. U.S. baby boomers own 55% of U.S. wealth and has not only been the richest generation of U.S. history, but of world history. By 2024, a majority of boomers will be retired, and this capital-rich demographic will shift away from long-term investments, like the 10-year bond, to short-term bonds and even cash. But the final break in the daisy chain will be the loss of confidence in the Federal Reserve and a slow reversal of globalization to more nationalistic economies that look inward for strength and growth. Brexit and the trade wars between China and the U.S. are examples of this deglobalization. The U.S. dollar is the global reserve currency, and if the world continues to close up and loses confidence in the U.S. economy, foreigners will require less U.S. dollars, creating another group of sellers of U.S. dollars and bonds. A great surge of U.S. dollars and bonds flooding the capital markets with less buyers will create a huge imbalance in the U.S. money supply that will eventually trigger the 10-year bond rate to increase. This bond market bust will most likely triple or quadruple the cost of borrowing for long-term investments in a very short period of time. The aftermath of the bond bubble burst will cause a chain of events that will lead to anemic real estate appreciation. It all starts with the heavily imbalanced money supply situation that I just explained. A side effect will be a weakening dollar, which will make goods and services more expensive, and as we learned earlier, higher short-term interest rates is the tool used to fight consumer inflation. But if you're a real estate investor or homeowner, it's the increasing long-term interest rates that will affect your wealth. Higher mortgage rates curb investment inflation, resulting in lower real estate valuations. By 2025, the 10-year bond can easily sit at about 6%, up from today's record lows of 1.5%. So what does that do to mortgage rates? Well, by 2025, we could see mortgage rates double to 7 or even 8%. Just imagine, today you're paying a 3.5% fixed rate on the median U.S. home price of $315,000. With 20% down, your monthly payment would be $1,415. Now, same scenario, doubling the mortgage rate to 7%. Your payment increases to $1,960, or $545 more a month. This scenario is a great example how important interest rates are to real estate prices. Not many people would pay $315,000 for that house when the payment is so high. So, supply and demand forces for housing will intervene, bringing the price of that house to a level that's acceptable to buyers, but only after the money supply has played its part. What about commercial cap rates? If the 10-year bond is at 6%, then commercial real estate investors are going to expect at least 8 to 9% capitalization rates for the extra risk. That means underwriting pro forma exit cap rates for 2025 at 7% could see returns severely undercut if the actual exit cap rate is 9%. This 2% difference between a pro forma exit cap rate of 7% versus an actual cap rate of 9% reduces exit equity by almost 30%. And this would just be the beginning, as mortgage and cap rates slowly increase, peaking in the early 2040s. After the money supply resets in our economy, real estate investment returns will be less dependent on appreciation and more dependent on cash flow. Those real estate investments with the ability to produce bigger income streams will be the safest and most profitable. Multifamily properties located in growth markets combined with business and landlord-friendly governments within low-tax states will fare best in the decades to come. Because remember, real estate investors will be competing for consumers' income as consumer prices rise from inflation and state and federal governments raise taxes to help pay for the increasing federal and state budget deficits. To maximize real estate investment returns, the selection process will be even more crucial for the right property class, state, city, and submarket. While there are so many investment choices in the real estate space to pursue, Michelson's investor group strongly believes that multifamily will arguably be the most lucrative real estate investment vehicle during this new economic order. Here are some of the reasons why multifamily will accelerate your wealth faster than single family. Number 1, scale forced appreciation. The ability to force appreciation at scale is multifamily's biggest advantage. Residential investment's biggest weakness is its dependence on surrounding home values to rise. For example, if rents increase by $20 a month on a 100-unit building, the yearly net operating income will have increased by $24,000. This one modest rental increase just raised the value of that property by $240,000. With multifamily, more income equals more appreciation. And multifamily has multiple income levers that can force a 10-foot wave of appreciation, while single-family appreciation will only feel like a 5-foot wave. Number 2, demand. The two largest generations in American history, millennials and baby boomers, are preferring to rent over home ownership as many are attracted to the lifestyle and affordability that multifamily properties offer. According to Yardi Matrix, over 800,000 renters will be added to the market per year until 2030, and 2/3 of them will go to multifamily. Number 3, economies of scale. Multifamily creates an easier management structure with multiple units on one address versus several single-family rentals at different addresses, providing greater opportunity to leverage time and profit while reducing investment risk. Number 4, big cash flow. A modest rental increase across multiple units can result in much bigger cash flow. There's also safety in numbers. A 5% vacancy rate on a 100-unit building will barely affect cash flow. A vacant rental house produces no cash flow. Number 5, favorable lending. Believe it or not, it's actually easier to get a loan on a commercial property because lenders evaluate the property's income potential. Residential lenders focus on the buyer's income potential. Number 6, one exit. If you need to recoup your capital, you'll just have one exit strategy to deal with when you own multifamily. If you have a dozen single-family homes, that's 12 properties that you need to market and sell in order to liquidate. One specific multifamily type that we love is apartments, which have very strong demand drivers over the next 15 years. Millennials have been the primary demand driver for apartments over the past decade. But according to this projection from rentcafe.com, it will be baby boomers that fuel a retirement downsize wave of new renters through 2035. The millennials and boomers total about 150 million people, which is roughly half the size of the U.S. population. Home ownership rates for those under 35 years old fell from 43% in 2007 to 37% in 2018. And all indications show that the younger generations will continue to rent rather than purchase homes in the near term for a variety of reasons, from costly student loan payments to frequent job changes and difficulty securing loans. But the boomers will be the next huge demand driver of apartments over the next decade because 74% of boomers are undersaved on retirement, and many of those boomers will need to sell their homes in order to subsidize their retirement plans. In fact, it's projected that from 2017 to 2035, the over 60 renter category will double from 9.4 million to 18.6 million households, and many of these boomers will most likely rent apartments. Together, these demographic and lifestyle dynamics between millennials and baby boomers will be a huge tailwind, offering significant protection for apartment owners now and in the decades to come. It's time to wrap things up, so let's summarize here. The U.S. is at a once-in-a-lifetime tipping point with record-high investment inflation, fueled by an extraordinarily high money supply, record-low interest rates, and the biggest demographic surge in history investing for retirement, who are also competing for returns with foreign investors that have very few barriers to entry in U.S. financial markets. These money supply and demand fundamentals have led us to the greatest financial bubble in history for stocks and bonds, and have set the foundation for America's last great real estate wealth building window. During times of crisis, strategy can lead to opportunity and self-preservation, or risk and self-destruction. One of the best stories ever told is the Great Patriotic War of 1812, when Napoleon's great army invaded Russia. At the start of the invasion, the great army numbered around 700,000 soldiers. It was the largest army to have ever been assembled in the history of warfare. Napoleon rapidly marched his army through western Russia, winning battle after battle as the Russian army slipped away every time, retreating deeper into the heart of their country. The Russians even abandoned and burned their dear Moscow so that they can lure the French even deeper into Russian territory. Eventually, Napoleon's great army suffered from the onset of the Russian winter. At the end of the French campaign, the great army was reduced from 700,000 to 30,000 soldiers. Even though the French won almost every battle, their strength and passion for continued military success led to more risk and their own self-destruction, and the beginning of the end of Napoleon's empire. When asked, General Kutuzov, who was the commander-in-chief of the Russian forces, to what he owed this victory over one of the greatest armies ever assembled, he simply answered, time and patience. General Kutuzov lured the French deep into Russian territory and patiently waited for the winter to finish the war. Well, winter is coming to the U.S. financial markets in 2020 or 2021. Today, if you're trying to buy a home, then stop and just wait. If you want to preserve and grow your wealth quickly and safely, then stay liquid. Current real estate owners, sell the ones that you hate and keep the ones that you love. Investors that absolutely must deploy capital, be picky on the debt, state, market, submarket, and property class. Stick to B-class multifamily in A and B areas that produce income from day one and lock in long-term debt. Syndicators, prepare to lose every acquisition battle and stay focused on winning the war. This means short-term, bid on deals for the experience, to grow your network and build your brand. Let others take on risk like Napoleon's great army. Long-term, be ready to leverage that experience, network, and well-capitalized partners for America's last great real estate wealth building window. Remember, time and patience can literally make you wealthy. Just imagine if you got liquid like Joe Kennedy. In 1929, before the crash, Kennedy's fortune was estimated to be $4 million, the equivalent of $8 million today. And just 6 years later, in 1935, in the midst of the greatest depression the world had ever seen, his wealth had increased to $180 million, equivalent to $3.3 billion today. Joe ultimately sired the Kennedy dynasty in American politics from the wealth generated following the 1929 tipping point. Thanks for listening. We're going to continue to monitor how America's last great real estate wealth building window will unfold. If you'd like to get updates from Michelson's Investor Group, then please subscribe to our free news and events e-letter and YouTube channel clicking the links below. If you found this informative, then please forward it to everyone you know. Because real estate investors or not, we're all going to be affected by the conditions leading to America's last great real estate wealth building window.